Okay guys, welcome to 13 Market Moves educational series. This is Brandon. Today I'd like to talk to you specifically about call spreads and some of the mechanics of doing call spread. However, in the market tops, as well as where there is a extreme valuations in the premium, especially now, we are definitely making a top and blow off top. I thought it'd be a great time to go over a specific aspects of the call spreads. And so today's purpose really is to go over the basics of call spreads and the types. Are you bearish or bullish? We want to sort of introduce the hedging or financing your options trade. Okay, you always hear about people hedging, and that's just sometimes a very, very good policy to make sure your downside is somewhat protected. Okay. Or you can also, because in the event, like we're going to be looking at Tesla quite a bit, where the premiums are just outrageous because of the implied volatility and the magnitude of the potential moves. And when the stocks are kind of at their all-time highs, kind of hitting up against a blow-off top situation, it bears in mind to look into hedging your positions, but also into protecting your downside on your accounts. So we want to go over when to execute a bullish and bearish call spread. Number 4, we want to look at the mechanics of calculating and executing a call spread. We will also go overview of the Thinkorswim options chain and Traders Workstation platform in executing these trades. And we want to go over these examples while the iron's hot. Today, actually, when I'm making this video is actually August 26, 2020. And so I hope this resonates well. Now, the basics of call spread is divided into bullish and bearish camps. And you notice that I'm not talking about the puts. And part of the reason is doing the spreads on the puts, whether you're doing a bullish spread or a bearish spread, puts you at risk for assignment of those shares in which you are obligated to purchase those shares, especially if the trade moves against you. Whereas the call spreads, really, if the trade moves against you, you only have the downside risk of your maximum loss. And what I like about call spreads or put spreads or vertical spreads in general is that your downside is defined, whereas if you are buying directional calls or puts, your downside is basically zero, right? And so it bears to mind that as long as you're good about your account management, you know what your downside is, and you basically are protected if you're wrong. But there are two types, and today we're going to be focusing on the basics of call spreads. Okay, there's the bullish call spread, or sometimes it's known as the bullish vertical spread, or long vertical spread. Okay, so one of the things that I want to kind of put into here is that, okay, sometimes these are known as long, okay, vertical spread. The bearish vertical spread sometimes are called short vertical spread. Okay, now we're going to go into more detail on these specifically later on. But I wanted you to understand that we are looking basically at bullish call spreads today and the bearish call spread. Okay, and the kind of the difference between those. And we'll talk a little bit about it, but we're really going to focus on bearish calls. And for now, due to the urgency of the market condition, and because it could chop sideways at this topping pattern for a little while, we really, if you're interested in shorting, we really want to start to protect our downside. So we'll only focus on the bearish call spread on this video because it's the most pertinent. Okay, and of course, there is a full course available. And if you like what you saw and if it helps you and it kind of, adds a repertoire to your trading and, you're interested in learning more, we do have a full course. And so talk to us about how to get the full comprehensive course on vertical spreads. And we will be more comprehensive. It'll have a lot more basic knowledge into there. But in this course, I'm just going to assume that you've traded before and you understand some of the terminologies. Now, so since we're going to be focusing on bearish call spread or bearish call vertical spreads, or we're going to be selling the vertical call spreads, or simply put, selling the spreads. Okay, there's many ways to slice this, but remember, you are buying call if you are bearish, because our market right now went like this, right? From March, and then now we're just right here, and then the big unknown is if this is the kind of resistance level, are we still going to go up, or are we going to pop up here and then come back down? What goes up must come down, but the markets can remain insane for a longer period than your account will allow you to. So the second thing is really the biggest enemy of any options contract, whether you buy calls or puts, is data, right? It's the time decay. The longer you sit and the longer it moves away from you, or the longer it chops sideways like it's doing today, your time decay happens and your premium just melts like ice, okay? That's the effect of buying directional puts. That is the one drawback. If you don't know your timing, and in a very highly manipulated markets that we see right now, you're going to see that these directional puts, you got to be right on your timing. And even the best of us right now are struggling in finding tops. And really picking tops and bottoms really sometimes can be considered a fool's game. But at 13 market moves, we're pretty damn good at it because of our 13 market moves pattern and our chart divergences that we employ. But we're going to be adding this repertoire so that this helps you. This allows you to be wrong without taking a massive damage. It also allows you to have as much of a defined percentage gain, but while minimizing your risk. So while you're hedging your risk, minimizing your downside comes at a price. And that is you have a defined risk level, meaning that you have a defined number of dollars that you can lose. And then after that, you will not have an options contract that will go to zero. This also eliminates assignment risk, like I talked about, of buying put vertical spreads. Whether you're buying long vertical spreads on the puts or the short vertical spreads, you still have assignment risk, because the problem is that on the put side, you are obligated to receive that particular shares and buy it if the trade goes against you. And more on that at a later course. This is most effective during stubborn market topping or bottoming, for that matter, patterns. And like I said before, we like to use call spreads with a bearish bias when we're picking these top. We do not want to mess around with put spreads, because while it's rare, it does happen. I've been caught in it, and I've been trading a long time. Okay, I've made and lost millions doing this crap right here. So I've learned. Old dogs can learn. And so bearish call spread is where you want to be. Or the other thing is, besides the top stubborn market topping process, it's the bullish trend has limited upside, which we think it is right now. I mean, are you kidding me? Maybe they have another 20, 30, maybe 100 points more on the S&P, or when it relates to Tesla. Some analysts came up with a $2,500 price target. And guess what? At the market top, analysts raised prices to an extreme level. Okay? And so that's basically what we're looking at. And so what we want to do is have a mechanism, because, this insanity can last a little bit longer than it is. The other reason for doing this is option premiums are too high, or your account size will not allow for writing or selling contracts right here. Okay, so what that means is, for those of you with smaller contracts, one thing I do want to say, in order to do any type of spreads, you need $2,000 in your account for margin. Without margin, you can't do this. If you have a cash account, you cannot do this. So for those of you, I know why you do it. If you have a cash account, get out of it. Okay? Make sure you have enough account so that you can have margin account, so it gives you flexibility. Okay? But when your options premium, like in Tesla, is too high and you can't afford it, we talked about this. You can finance this too. But we'll go over that later. You can let the markets pay for some of that stuff. But right now, we're going to be focused on bearish call spreads using our greatest trading stock of all time, Tesla, as an example. Okay, so let's get moving on this. Okay, we're back. Okay, so I wanted to quickly go over mechanics and calculations. I know there's a lot of words here, but trust me, this is comprehensive, and I swear I will take you through this, and I will do a lot of mock-ups and markups on this. But you need to understand the mechanics in calculating these vertical spreads, especially in the vertical call spread that has a bearish bias, or vertical short spreads. Okay, so we want to talk about profit or loss when selling when we're selling. When we say selling versus buying, we are bearish and we have a bearish bias and we are shorting this call vertical spread. Selling, okay? We are bearish. Okay? And that's the only topic we're going to cover here. But typically, selling at the money or near the money call strike. So the first component is if we had an options chain, and this is on the put side. Okay, this is in the money, and this is at the money. And, maybe 4, 5, 6, 7, 8, 9, 10 strikes on Tesla are considered near the money. Okay. So we want to be selling at the money or near the money calls, which means is that we become the contract writers. Okay. So that means that, let's say stock XYZ is trading at $10 a premium. When you sell that, you get to pocket that $10 premium. And each contract controls 100 shares. So what is that? Okay, that's $1,000 a premium. That goes right into your account. Boom. Wow, you just made $1,000, but that comes with a price, right? What if you just shorted that and XYZ stock keeps rising. Okay, in this situation, you just wrote a naked put contract. Okay, now your broker won't allow you unless you have $1 million in there, at least a couple $100,000 in there to cover some of this stuff, the margin. But so we want to protect our downside, right? We're bearish. We want to pocket this premium, but we don't want infinite risk. Okay, it's all about risk. When you're doing spreads, you better get really good at thinking about risk. Okay, so we received that money, the $1,000 that I told you about, in the form of a credit. Okay, if they take money or you buy something, you buy a call, you buy a put, okay, or you buy a call vertical spread, then those are called debit because it debited your account. Okay, to buy that. Okay, did that make sense? Okay, in other words, credit is selling or shorting at the money or near the money calls. Okay, that's the first component. The second component is buying the out of the money calls. So one, you sell, which you're shorting, and you're writing the contract. You wrote the contract for the call for whatever price. And then you go and slightly out of the money. Let's say you sold here and you basically sell out of the money calls. Okay, that's the mechanics. So let's say this is a $100 strike price, and then you sell, let's say, 120 strike. So you sell here and you buy here. Okay, so that's a spread. Okay, the distance between this $100 and $120 is what's known as the spread. Okay. Essentially, what you're saying is, look, I want the $1,000 because it's trading at $10 per premium in my account. I do not believe your stock is going to go above $120 by expiration. Now, before expiration, if the stock goes 105, 110, basically, even though you're keeping this, it's going to be this minus what these contracts are worth. So this is your insurance. Okay, so basically, what we are talking about is creating that spread, and we went through that example. It is imperative that we understand this aspect, that when you're doing a spread, one component, especially the bearish spread, is you're going to do near the money or at the money spread. We're going to sell those, pocket the premium, which is called a credit. And then to protect against infinite downside on this situation, you could end up owing more than what you got the premium for. Let's say you got $1,000 and Tesla rips up 500 points. Well, guess what? You're going to owe all that. To protect that downside, we want to buy out of the money call. Okay, just like when you buy a normal call. Okay, you're going to buy this, so you're going to spend money buying this. The difference between what you sold and got the premium, $1,000 here, and then out of the money call, let's say in this situation, it's like $3, so you're $300. The difference is that you get to pocket $700. You finance this by selling that premium. You do get immediate profit expressed as credit, okay? Just like here. Basically, what you sold minus what it cost you to buy this insurance. Your goal isn't to make infinite number amounts of money. Your goal is to make that $700 spread by the expiration date, or basically get so far out of the money that this is no longer irrelevant and this is relevant. You just pocket it in. You do this when premium is high and you expect that premium to go down and become worthless by expiration. Okay. Now, you don't have to hold it till expiration. Heck, if you got $1,000 premium and it basically slowly starts to go towards expiration date, and you have a credit of not $1,000 because it's fluctuating, but like $500, and you want to take that, you just close out this position, and we'll go over that. Okay. Now, loss occurs when underlying strike price exceeds the out of the money call strike, meaning that basically you have your spread here. You sold here, and then you bought here, right? What happens if XYZ stock goes to 200? Okay. What happens then? Well, at that point, what happens is, let's say you got 1,000 from here, but you paid 300 to get this in our previous example for a net credit of $700 minus commissions. Don't forget commissions. It's really cheap nowadays, so it's negligible, but you have to consider commissions. What happens if it goes to 200? Do you owe additional spread there? I mean, you got 1,000, but at that point, if this thing goes to 200, I mean, you're liable for $10,000 plus, right? And you may not have that cash. Well, good news, in this situation, all you lose is $700. Your maximum loss is defined, okay? Okay, your max loss is defined. Okay? How great is that? So, if you're right, because remember, 90% of all options generally will expire worthless, right? So if you know that and you can play this game, you can play this all day long. And if you have a larger account, sometimes it's a smarter way, especially when we are at the market top. We don't really know what's going to happen. All we know is that the upside is limited, okay? Now, we're going to use Tesla as an example, partly because we believe, you have to be sure, it's not going to rip any time higher. But if you're buying just naked calls or puts, especially puts, betting that it's going to go down, you're going to lose 100% of that premium. Why not finance it so that you only lose partial aspect of it? And if you're right, or if it doesn't move, it just sits there, or basically it goes down in price, well, then at that point, the further it goes down in this situation, you're going to keep all of your $700 of premium. Now, here's an example that we've been going through, and I'm going to reiterate what we talked about. I'm going to use slightly different numbers to help you. XYZ is our fictitious stock, is trading at historical highs of 100. Just like I said, it's at $100, okay? You believe that the upside is limited, okay? This is the key right here. And stock is exhibiting a topping pattern, okay? Remember from our chart divergences, we got to look at those topping patterns, okay? So what we want to be able to do is really, so you want to take advantage of it. Really want to take advantage of this ridiculously high options premium. Sounds like something we know, right? But, ridiculous stocks tend to continue to rise sometimes. On the call side, right? It's like ridiculously high options premium on the call side. Remember, we don't want to play with spreads or anytime you're selling things on the put side, because the assignment risk, where you are forced, if your trade goes against you, you're going to get assigned stocks. And if you don't have money, they're going to have all kinds of margin calls and your life gets ruined. So let's avoid that, right? Our job is to make money, not pay more than what we risked. Since it is too expensive to buy the calls and it's very toppy, you can finance it. Remember, I told you, you can finance that premium and get paid immediately by selling, remember, or shorting, okay, or bearish call vertical spread. Okay, this is what I'm talking about right here. Okay, this is what I'm talking about. You can take the near the money call strike. Okay, remember, it's trading at $100. Okay, so we're going to take the 102 and sell it. Okay, that means you get money in your account. They give you a credit in your account, okay, for whatever it's trading for. It's currently trading at $7 per contract, which means that in your account, it's going to give you $700 in your account, okay? Then you go out and buy a out-of-the-money call strike, just like you would if you think that this was going to go to the moon. But this is the hedge. This part is the hedge, okay? So we're going to go to 112 and buy it. And it currently trades at 200, right? $2 times 100 shares that it controls per contract is $200. So effectively, your credit is, on the premium side, $7 minus 2 equals 5, or, let's do this, $500. Okay, that's what gets deposited, minus commissions. Don't forget commissions. Okay. Okay, so your credit is $5 per contract in this example, minus the commission of $1, okay, let's say, for each leg. So that's going to be times 2, right? You got the selling put side and then selling call side and then buying call side. Okay, I hope that makes sense. So the real net credit into your account isn't 500 because of these pesky commissions, right? So the pesky commissions are $300 in your account, just like I said here. So if you only sold one call vertical spread, okay, right here, you would gain 3 times 100, just like us, $300. That's your profit. Bam, right? Bam, bam, bam. Okay, cool. Wow. I didn't have to do anything. I got $300 in my account. I'm happy, right? Great, right? Well, not really. Only great if by the expiration date, the XYZ stock does not get past 112, right? Okay. So what happens if XYZ stock exceeds past 112 by expiration? Well, you still get to keep the $300, but at that point, now 112 is going to trade at $11 on the expiration date, for example. Okay? Well, that means that it blows out your $300, but because you have this 112 call protecting you, your maximum loss in this situation is your $300, okay, minus, okay, so what is your $300 minus the original, what? You pay $2 for this, and then $7 here, to $5, okay? Okay, the $5 of difference that you have is really your risk. And so your maximum loss, well, it'll be calculated for you, but you need to learn to calculate this before you get in. Your max loss is $500 in your account. Okay. So in this example, what if it does go to 120? What is your maximum loss? It's like, unlike buying directional puts or selling non-spread unhedged options, like we do at 13 market moves, selling vertical spread limits your liability. So your maximum loss is basically your OTM strike. Okay, in this situation, it's 112. This is the fastest way to calculate it. Minus the near the money strike, where you basically bought the premium, which is 102. Okay, $10 is your maximum loss. But wait a minute, you got a credit of $3, did you not? Okay, so going in, you know your defined loss is $7 or $700. If everything goes to hell, you don't owe infinite amounts of money. You know what you're willing to lose. For each contract that you write, you're liable for $700 if it exceeds your target range. Let me state that again. If the stock moves above a certain level, then that is your maximum loss. It's not infinite, okay? And your maximum gain, we already calculated it, okay, is $300. You already have that in your account, okay? So none of these events happen. This is the credit. That's your profit, okay, for doing nothing. And especially if the stock isn't moving or it's not going to move as far as you think, or you're getting closer to the options expiration and the premiums are high, this is the way to do it, okay? Just chew on that, pause this video and just think about this, and then do it over and over again in your head, okay? And I need you to understand the maximum loss calculation before you even get in, or your trading platform will do it for you, but you know, it's always a good idea to kind of be able to calculate this pretty fast in your head, okay? So let me put it to you in a more simplistic, simplified fashion. It's that same XYZ, okay, or XYZ, okay. It is the hottest stock in the world, and it is the hottest stock in the world. Currently, it's trading at $100, so that's right at the money. Premium is 12, 101s are 9. As we discussed, we're interested in selling a vertical spread, call spread in this situation at 102. We're going to sell this guy. We want to sell this, and we want to buy this. Okay. Buy. Okay. This is out of the money. Premium is cheaper because likelihood of it hitting 112 is minimal. So don't worry about this for now. So the credit you get is $7, basically the spread, right? The spread. $7 minus 2. Okay, but don't forget the commissions. It's in this hypothetical situation, we're back in the year 2000 or something, or 2010, 15, where options contracts were trading at $1. Actually, that was cheap. You know, I remember not too long ago, TD Ameritrade was charging $1.65 per contract. Then it went down to 65 cents. It should be free, but who cares? Okay, there's two legs here. So your contract liability premium, your commission is $2. So your spread is $7 minus 2 for a net spread credit of $5 minus your $2. So $3 in premium gets deposited into your account, but each contract controls 100 shares, so it becomes $300 for each one contract that you participate in on this selling of the call vertical spread. Okay, so this is where we went, $3 per contract. Each contract controls 100 shares of XYZ, so credit is $300 paid immediately to your trading account. But here's the thing, guys. Just because let's say you started with $2,000, your account is going to show that you have $2,300. But it's going to, on the margin section, it's going to have a margin cost. Okay. Remember, I told you that basically your margin requirements are calculated by the spread here. So in this situation, the spread between what you sold and what you bought is $10 right here. Okay? Minus the credit that you got, that's yours forever, whether your trade goes sideways, upside, or against you. Okay? Your margin liability, because that's what you're going to be liable for, is $700. Okay? Even though you have $2,300 in here, your broker will limit your buying power now. Your buying power gets reduced to $1,300. If you buy two, that gets diminished by $1,400 if you buy two. Okay, so then your buying power gets diminished to $600. Please understand this aspect. You need to know how to calculate ahead of time or estimate what your margin requirement will be. It's very simple. It's right here. It's the difference of the spread, which is $10, minus the credit that you got. If you sold $7 and did 2, that's 5, minus your commission, $2, that's 3, times 100 equals 300. Okay, so, but you have to also know a hypothetical situation. What if the stock does go to 120? Okay, this is no different than Tesla doing this crap, right? Oh, it's too high, and it just comes down. You get all excited, and it bounces up. Oh, it can't do much. Makes a bull flag in the meantime here, and it goes right here. So XYZ goes to 120. You're going, impossible. Market's at all-time highs. Short interest is at its lowest level. Put to call ratio is like at ridiculously low levels. What the hell is going on? It doesn't matter. You don't argue with the market. It goes to 120. It's currently trading at 155. But if it basically gets in the money, now that 120 is now trading at $12, right? That's a lot of liability, right? But because you bought this insurance right here, your liability is still 700, not 1200. Can you imagine that? Times 100? What is that? That's 12K in liability if you did this naked. But let's say it hovers around 112, right, on the expiration day, and then it finished, it's at 11.99. Well, this one's out, and this one expires worthless. You get to keep all of your premium right here, $300, okay? Now, I mean, you can sell this before the expiration. Let's say everything's going your way. I mean, Tesla starts to tank really, really badly. And then, you know, it's at like 285. And you go, you know what? I don't want to wait. This is still close enough. I want to close out my account so I could free my margin, right? If I want to free my margin, that's the way to do it. How many times have you seen Tesla do this where it gets you all excited? Let's say you're in the spread and you go, holy cow. Although we're talking about XYZ, but I like to interchange this with Tesla, right? How many times have you seen this? And then all of a sudden it sells out sharply. It does this, and then it does something like this, and Elon Musk comes out, a 5-to-1 split, and then it does this, right? And you bought your spreads right here. It did go down, and you covered here, right? What if you didn't cover because you thought it was going to go down and you have other trades going on? You have a big account, you didn't pay attention, and it rips up, okay? Well, you got to take profits when it's prudent, right? In this situation, you know, your cost on this thing is just so minuscule. You know, this is 100% gain, right? And you just now let that turn into a $700 loss. But if you naked wrote that, or basically you bought the directional put, or you basically sold calls at this level because you're bearish, but you don't want to play with puts. Remember, do not sell puts, okay? Assignment risk. Okay, that's your maximum loss. Not so shabby. I'd rather take that than a 12K loss. Would you not? I would rather take that than paying, let's say, put at that time. Let's say you bought puts and it was going for $9, right? And let's say it went for 12. Puts are a little more expensive sometimes, $1,200. You still came out ahead. And the reason why we're asking you to think about this is because, because the time decay is real. The premiums are really, really high on these high-flying stocks. And so the issue is that we want to make sure that we protect our downside. And then this is a really good way of protecting your downside and pocketing 100% of your premiums in a very short order of time, especially where there's an imbalance of contracts. So let's get into overview of the Thinkorswim platform and how this gets executed. I will be using Tesla, our favorite, greatest trading stock of all time, as an example. Okay, guys, so here we are face to face with Tesla. We're going to look at let's look at, it's got 2 days left. Generally, I advocate you to buy a little more time, but it can work with 2 days left to expiration. Just be careful about the spreads, okay? So we do not advocate, if you are bearish and you want to do spreads, must not do the following, okay? So let me just... Okay, so this is the option chain. I have a big X on the put side because I don't want you to focus on there. I want to go over the mechanics of doing this. Okay, so I want to push up, this entry side. And now Tesla is, with 2 days left to go, the premium near the money is 47.85 bid, right here. Okay, and then 48.35, 48.30 ask. One thing funny you're going to notice is that if you go to the bid side, it'll sell, has a sell moniker. And if you go to the ask side, buy. If you want to buy directional, this is where you click. If you want to sell and become a seller, you go to the bid and click on it. Okay, but let's give it a example. So we know we want to make sure that we have a pretty sufficient cushion in case Tesla decides to rip up. Because even if you go down another 100 points from here, let's say we go to 2180 or something. Okay, let's go to 2200. It's still 23 bucks. You're going, geez, I don't think Tesla's going to rip up 100 points by Friday, do you? It might. So you go, okay. But look at this. Look how the premiums drop off here. Wow, that's great. Okay, so here's what I would do. I would look at something like this and go to Tesla and then pick the 21.95 strike. Okay, because for me, that's out of the money. The further out in the strikes, and as long as there's a spread, this is why Tesla is such a golden stock to sell call spreads on. It's because you can go here and then go to 21.90. Okay, maybe go to 2200 right here. And then let's sell, and then let's have a spread, and if it goes into that area, let's get this. Let's get how many strikes? 1, 2, 3, 4. That's pretty traditional, okay? So let's do this spread here, okay? So I'm going to go, and you can either do one thing. You can either individually click, okay? Or you can right-click and then go to buy or sell. We can say single or vertical. Oh my gosh, it tells you how to do it. Vertical. So here you go. It goes, you're going to sell 2200 and you're going to buy, it says 2250, but we're going to go and do 2250. Instead of 2400, let's go to 2200. Let's go to 2300. Okay. In this example. Okay. If it actually comes down here, it means it's going to be ripping higher, right? We want to protect our downside, and there's like a $7 a premium. So even right here would be good. So let's do that, just like it's at 2250. But if you want to be adventuresome, you can change your strike prices right here. Okay, so right here, notice that it says sell and it says buy. We're selling the contract, we're seller here, we're buying directional here. I don't want to pay $13.50. I want a little bit more. I think that if Tesla's going to rip and get to this level, I think that there may be like a 2,300 possibility. Okay, so I'm going to do that. What is your credit? You're going to get $1,200 for this credit as long as your margin is capable of covering this. Let's say we want to confirm and send here. You push confirm and send. It's going to tell you a few things, and this is very important to note. Okay, it says your max profit is $12.52. Your maximum loss, however, is $8,748. Okay. Now, if you bought, not including the dividend risk, okay, cost of the trade is $12.52 minus $1.30, which is your commission. So this calculates it all out for you. But let's say you go, whoa, 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 that's way too much risk for me. I don't have 8K in my account, okay? And well, it's not going to let you because that's your margin requirement. So let's say, okay, screw that. Let's go and do this. Instead of taking it out here, let's do our original plan right here. And then let's go and sell the 2090, okay? And then let's go do this, okay? So what are we doing here? Okay, let me delete this. Let's go sell this guy. Okay. Oops. Let's go right, sell, vertical. And then here it is, 772. Okay, 2200, sell the 2200, buy the 2250. I right clicked into this. You can always change whatever calls and you can play around with this. And then let's click on confirm and send. Again, you got to pay attention to this. Your maximum loss in this situation, okay, is $42.25. Okay, but your maximum profit that you're going to protect is $775. Okay, so that's the maximum profit. You're going to make $775. Okay, and that's kind of where it works. So this is your margin requirement, resulting buying power for the stock. Okay, this is what gets diminished. Okay, let's delete this. Okay. So what we want to do is kind of figure out the mathematics in this situation. Okay, so we know that the difference between 2025 and 1305 is about $7. Okay, the strike, however, is very, very wide. The reason why it's high in this situation is because 2200 minus 2050, okay, is about a $50 difference. 50 times 100 is $5,000. Okay, there's that risk. Okay, but if you have a large enough account, this is pretty lucrative in a sense. Okay, for me, I think the risk of Tesla coming all the way down here is minimal. And so, how do you determine the probability that your trade will pay out? Okay. Well, this has probability section. So when you're down here, these probabilities of out of the money, okay, that expiring worthless is calculated for you. You have 75.76% of this working out in your favor. I would take that bet. Okay. If you're wrong, okay, the only downside right now is that you're only pocketing $750 worth of premium to take on a risk of $4,000. The risk to reward profile is not that great. Okay, you want to minimize and protect your downside. Part of that is because it's not trading at dollar intervals. There's like a $5 wide things. Okay, so you might be better off, for example, staying closer to the money, but now your risk increases the closer you're near the money. But let's go to here where the spreads are not $50 wide. Okay, let's do this. Okay, let's do here. Let's do a $10 wide thing. Let's sell here. Okay, we're going to do advanced order. Okay. We're going to put it on blast all. That tells us that you can click instead of right clicking. Let's do this. Let's get here. And then, so let's click on 2190 like we did. And then let's sell this. It's only, okay. Let's buy this as a spread. Now, let's calculate this, okay? When we calculate this, we want to push confirm and send. It tells you the cost. You're going to get a credit of $22.15. We're going to sell a vertical because we're bearish. 2190, 2195. Well, we don't want to go to 2195. We want to go to 2200. Okay, we're going to get a credit of $2. Okay, but let's say, well, I'm willing to lose like 1500. Okay, so let's go to like 2200. So this is up to you. Here we go. Oh, this one's not traded. Okay, let's go to 2200. Let's see what your risk is now. You're going to pocket maximum profit of 207, but this is pretty far out of the money, but your risk is 794. Okay, you're getting a credit minus the commission of 205. That goes right into your bank. Okay, you can do this all day long, and this is a quick fire way if you have enough position to do a bearish call spread. Now, how do we do this on, let's say, Interactive Brokers? So we're in the Interactive Brokers, and we have Tesla. Okay, so in this situation, it's the same thing. We don't want to do puts. We want to look in the call side right here. Okay, so on the call side, if you want to do and sell this, we do the following. We come down here and it says strategy builder on or off. If you turn it off, this is what happens. If you turn it on, this comes on. You can go to the strategies and then click down on it. You can do butterfly, and then we're going to click on vertical spread. Okay, so it says click on a leg to apply vertical spread. Okay, so we're going to do that. Okay, so in that same example, let's say we're a little adventuresome. We're going, well, you know, the spreads are pretty tight right here. Okay, so I'm going to sell this one and then try to pocket a $37 premium. Okay, and then we can hold shift to move strategies up and down. See that? It's really nifty. Okay. And so what we have is basically what it does all the calculations for you, right? So basically what you have is a margin impacted. It's going to tell you $1,000 have been impacted because you're closer to the money. You're taking a little bit more risk, but there's only 2 days. And I don't believe Tesla is going to go much higher for at least a few days. Here's the credit that you get, $320. Remember that other example, when you're further out the money, your profit profile also diminishes because of the effects of the delta. Okay, so look at this order limit. We're going to buy one quantity. You can change your quantities here if you want to buy 2. Then look how this impacts $2,000, and you get 320 times 2, $600. Okay, so let's go back to 1 so that we can show this. Okay, credit, this is day. Okay, and then what we want to do is, and it gives you a little graph here. See, this is where our maximum profit zone is, right here. Anytime it goes to here, you lose money. You lose 1,000 here, you'll lose 1,000 there. If it goes too high, too low. Okay? So what we want to be able to do in this vertical spread example is to, let's go to submit order. Okay? Okay, I'm going to say accept and continue. So it will calculate everything for you. Okay? It's going to say we're selling this right here, selling one of Tesla 2130, buying one of Tesla 2140. Okay, the limit price, this is credit. See how it says credit? That's going to go into your account, $367.50. Okay, so it's going to tell you the current, account. This is our small account. Maintenance margin requirement is 1,000. It will not let you trade this without it, but it will tell you, okay, that if you trade it will tell you just exactly what your risk is. Your risk is $1,000. If everything goes to heck, you're only going to lose $1,000. If you bought puts here and at $4,100, you would have lost $4,100, right? And so this is what's really cool about these spreads. You get to pocket your money, and as long as you think that the market is basically churning or that there's no more upside, but because it's at all-time highs and the premiums are crazy, this is one way to capitalize on 100% gain. Okay, so this is kind of how we do this, and you can pause this and go over this over and over again. Okay guys, so I hope that made sense. I think it's a prime time to be using this. It allows you to hedge your downside, but also pocket some premiums without worrying about directionality or theta decay. And, this can go on for, I think that downside could happen at any time, but this type of movement up or down can happen. This volatility trading in a range in a choppy, slow grinding fashion can really eat up your account. This is one way to hedge your account and still make a more predictable and efficient way of bagging profits. Even though the previous example showed somewhere between $600 to $700 of credit, well, those are each of those money that you got basically for risking very little. And likelihood is most of these contracts will expire worthless during the expiration date. Okay. Now, if you want to learn more and get really to the nitty gritty and learn from the basics on up, we do have a full course available. So talk to one of our wonderful counselors about how to get the full comprehensive course on vertical spreads. But for now, learning how to short vertical call spreads or selling vertical call spread is very, very essential in these times. It's designed for times like this to minimize the risk, to finance some of your premiums with a bearish bias so that if you're wrong, you don't get your butt handed to you. Okay, so thank you for being part of 13 Market Moves, okay? And make sure you check out the 13 Market Moves course and all the other courses along with our Friday alert. It's the best way to learn and take your small account, even the smallest account, if you apply it correctly and learn and take advantage of the resources available to you, you'll trade like a rock star anytime. Okay, my name is Brandon once again. Thank you for listening and good luck to your trading and let's roll.